Okay, there we are. Hello, and welcome to the introduction to farm taxes. Let's see if I can get this off my screen. Okay. I'm Sarah Burnett Pierce, and we're going to be going over some, oh, it's on this screen too. Technical issues. There we go. We're going to be going over some basics on farm taxes. There's me and Simon, my livestock guardian dog. Want to know a little bit more about my background? It's all there. Today, we have quite a few topics to go over, and I want to make sure that we get to the urban tax credit information and the beneficial ownership reporting. So some of these slides are for references. It's laid out in a way that if you want to go back later and read more details, you should be able to do that. There are 4 basic types of tax preparers. Any of them can do farm taxes. The paid tax preparer is anybody that can walk in off the street and register for a FinCEN number with the IRS can prepare taxes. The enrolled agent needs to take a certification exam and report continuing education every year. The certified public accountant, which is probably the most known term, has an accounting degree and also takes a certification exam. The main difference I feel between enrolled agents and certified public accountants when it comes to preparing taxes is enrolled agents' education, background, continuing education is all focused on just taxes. Whereas CPAs tend to have a broader reference point. They have to do CE on accounting and taxes. So enrolled agents maybe have deeper things that they delve into. Certified public accountants have wider. They're both very good resources, just the same. Tax lawyers have to go to law school, and they are the only ones in certain cases that can represent people. Like if you go to the US tax court, you have to have a tax lawyer. Most of us will never use a tax lawyer. There are, let's see, there are more details on each of those types of repairs in the notes that you can go and look through if you're looking for a tax preparer and aren't sure what you need exactly. I have met good and not so good preparers in each of these groups. I work with someone who she has a FinCEN. She does not have a college degree, but she has 25 plus years of tax preparer experience. She's an excellent preparer. She knows a lot about especially estate tax returns. But I've also met some in that group and all the groups that they get the forms filled out, but they aren't really focused on the details. But the main factor is it has to be someone that you trust and someone that you feel is working with you to do the best job possible to get the tax return filed correctly. Price can also be a factor. The more certification, continuing education that people have, the more they tend to charge for their services. The enrolled agent, the certified public accountant, and the tax lawyer are the only ones that can represent you in front of the IRS if you have a letter or a question or an issue. The paid tax preparer is not authorized to do that. It doesn't matter so much which type you choose, just so long as you're comfortable with them, but you do have to be able to keep accurate records. Because if your records are not accurate with your farm accounting or any accounting, then the tax preparer cannot fill out the forms correctly. There's bookkeeping software. Sometimes it's a little bit expensive for the size of operation that people have. A lot of times these people turn to using Excel spreadsheets. I've seen some very good Excel spreadsheets that keep very close records of inventory and income expenses. They do take some time to build. You have to learn the Excel formulas, but they are a very useful tool. You can use paper ledgers. I still have some clients that do that. It takes time. Have to be careful with your handwriting. Make sure it's legible for your accountant or your tax preparer. A lot of people are moving to bookkeeping services. If you're having trouble keeping up, I suggest looking into this because for small operations, a lot of the smaller tax practices will offer bookkeeping services for a fairly reasonable price. If you factor in your time and being able to make timely and educated financial decisions about your business, having that little extra expense to pay someone else to do the bookkeeping can turn out to be a positive thing. You do need to keep all of your receipts for 7 years. Farms are classified as a business by the IRS, and those are the requirements. You can be audited anytime during that period. And if you are, they expect you to have a paper trail to back up everything that you've reported. You have to have the receipts legible. And I know that this is a real problem with Orscheln's receipts, which Orscheln's is no more, but they tend to fade, particularly if they've been left in the sun. And yeah, TSC Bachman. So you have to be careful and make sure that your receipts that you're keeping don't fade to nothing over time, something to consider. But do keep it up to date on a regular basis, because most tax preparers, they don't want you to bring in a box of receipts. If they do, they're most definitely going to charge you extra. They just want you to tell them the totals for each income and expense category that matches to the Schedule F. Okay, we're going to go over some common business structures because I find that people sometimes are confused by these different points, and we're going to have to know some understanding of these whenever we get into the beneficial ownership reporting information later. So we kind of have to have a basic knowledge. Sole proprietor, get my clicker to work. Okay. A sole proprietor is the most common farming operation. It's one person, they decide to farm, they don't have any employees, they file a Schedule F and attach it to their individual tax form, which is the 1040. No, that's okay. Okay. There isn't any paperwork that needs to be filed. You don't have to register with the state. It's very simple. You can choose to have a single member LLC for liability protection, but your tax treatment is not going to change. You'll always still just be a sole proprietor, and everything will be run under your Social Security number. Okay, my clicker is slow. You can also have a qualified joint venture, and I think a lot of people maybe have this and don't really know that's what it's called. I did for several years. Jim and I are legally married. We have a farming operation. I take care of the cotton sheep flock. He does the orchard and any market vegetables he decides to grow for the year. Whenever we file our taxes, I do a Schedule F for me on the sheep, all the income and expenses. I do a Schedule F for him on the orchard and the market garden, all of the income and expenses for him. We attach both Schedule Fs to our Form 1040 that we file married filing joint. And then whenever it is reported to the IRS, I get income credit or income acknowledgement of my income on that farm income, and he gets it on his. I do this for me personally because I grew up in a very traditional household. My dad was a farmer, and the income always went in under his Social Security number. So then whenever my mother would have reached retirement age, her Social Security would have been very little because it all went under his number. So I feel like this is a more accurate and fair way to report it if you both are actively participating in the farming operation. You don't have to divide it by product like the sheep and the orchard. You can say, we both work in this equally, so I'm going to take 50% of the income and expenses, and you're going to take 50% of the income and expenses. However you feel is most accurate to divide in. Qualified joint ventures cannot have an LLC. There are specific rules stating that that's just not allowed. Partnership gets a little bit more complicated. It is two people. They can be legally married. They can be neighbors. They can be people who just met on the street. You should have some documentation for your partnership. You should have an operating agreement and some written down terms, just because that way people have less of a tendency to forget what was said or get confused. But it's not actually required. A partnership is considered its own entity, and so it would have its own tax ID number, and it will file its own tax return, the Form 1065. These are due earlier than our tax date in April. They're due March the 15th, and that is because from the partnership return, K-1s are generated, which show each partner's part of the income and expenses. And then the partners take those K-1s and add them to their own individual tax return. It's very simple if you have your paperwork and everything written down for your agreement and a partnership to form an LLC, because you already have the structure in place. You just have to file the legal side of those documents. An S-Corp, probably most of the people listening today won't deal with being an S-Corp. It's a little bit more complicated business form structure. The owners can also be employees. They are also due March the 15th. The business itself is its own entity and files the Form 1120S. Really, unless you get up to $150,000 of net income, not just gross income, but net income after you've taken out all your expenses, you really, unless you're in a high risk business where you want the extra legal liability position, you really don't need an S-Corp. You can have one of the more simple forms of a business structure and have the same benefits with a lot less hassle and tracking and this sort of thing. Then the C corporation, which is Sprint as a corporation, Target as a corporation. Most farms are not corporations and not at the level we're discussing today. This is a legal question that I often get, that it's confused as a tax question, understandably, because it all kind of layers in together. Do I need an LLC? An LLC has no bearing on your taxes. If you have one or you don't have one, the IRS is indifferent to that, because the LLC is a legal agreement. It gives you liability protection. It keeps your personal assets safe and separate from your business assets if someone was to sue you or some other mishap like that. But as far as the IRS is concerned, it's still your money. You fill out the forms according to the regulations and they process the taxes due. This chart kind of gives a good example of if you're considering having an LLC, if you feel like you need one or not. The next slide is similar, but it shows you how the IRS disregards the LLC status. Okay, do we have any questions? That's Simon helping me check the livestock tanks last winter. He's always very helpful. Yes.
So, we just report it just regular income, just like we were to do for the YouTube app, or the Schedule C and then just put it in there.
All farm income. She asked if there were special ways that we needed to report farm income. Is that yes, the LLCs. When we get to the Schedule F, I'll go into this more detail, but the basics are every farm except big corporation farms file a Schedule F, which the schedules are an attachment to another tax form. You can't just send the Schedule F to the IRS. So you fill out the Schedule F with the farm income and expenses on it, and then you attach it to your tax form. If you're a sole proprietor, you attach it to your 1040. If you're a partnership, you attach it to the form 1065 for the partnership return. And that way, the IRS knows it's farm income that is under the umbrella of this business or this person. Does that answer your question? Okay. Okay. Any questions online? Okay. All right, we're going to dive into the beneficial ownership information. This is marginally a tax topic, but it is a very important topic for people. And so the tax community has kind of agreed as a whole to try to get as much information out about it as possible. It is new reporting requirements that went into effect January 1st, 2024. And it is that businesses, which domestic reporting companies is the term that they're using, must report their BOI, their beneficial ownership information, which we'll get into what that is, to FinCEN, which is the Financial Crimes and Enforcement Network. And it is the Department of the US Treasury. And it sounds really scary, but it doesn't really have anything to do with most of the people here. They're probably none of the people. Their purpose is to help fight crime that is hidden by shell companies and silent partners and things like that. Money laundering, drugs, those sorts of things. So they are dealing on a completely different level than most of us are. But in order to make sure that they don't miss anybody, they have decided, Congress has decided, that all the businesses, all of the domestic reporting companies, regardless of size, must do this reporting. Now, there are some exemptions to who is classified as domestic reporting company, and we'll get into that. But if you are a corporation, have an LLC, like formally filed through a lawyer, papers LLC, a partnership, even if you do not have an LLC, or if you have created by filing a document with a Secretary of State or similar office under the law of state or Indian tribe, which is basically just a coverall statement. They've been in there. So is a sole proprietorship a reporting company? This is one of the main questions we're getting right now from people is, okay, I farm by myself in this example. I put my farm income and expenses on my Schedule F. I attach it to my Form 1040 that I file individually or with my legal spouse. I don't have any business documents. I'm just me out there selling vegetables. So I'm a sole proprietor in this example. According to FinCEN, you don't necessarily have to report if you're a sole proprietor. However, if you are a sole proprietor who has gone with a lawyer and created an LLC to protect yourself legally from liability issues, then you do have to report. But like my tax business, I don't have an LLC. It's just me. I have applied for an EIN, an employer identification number, even though I do not have any employees. But some of the tax forms that I issue to people have to have my tax ID number on them. And I really don't want my Social Security number out there. So I have an EIN for that purpose. I also have registered with the Secretary of State, a DBA, doing business as, which is my fictitious name, Moxie Tax Solutions. But I can do all of those things and still be exempt from this reporting because I don't have an LLC. If I formed an LLC, then I would need to. I wanted to throw this slide in here because there are 23 exempt entities beyond the sole proprietor that are not required to report, but most of them are like financial planning agencies and things like that, because this regulation covers all business types. The only one I thought that might apply to some people today is if you have a 501c3, you might not need to report. So who is a beneficial owner for a business? It is an individual who directly or indirectly exercises substantial control or owns at least 25% of the company. Now, there has been some discussion on tax professional discussion boards that, okay, what does exercise substantial control mean? Because I have my tax business, it's just me. But if I discuss things with Jim, my partner, and he has substantial influence over my decisions on what I do in my business, he doesn't. But if he did, then do I need to also report him as a beneficial owner? Right now, the conclusion is no. But we're still, this is new, so we're still getting information from FinCEN on what exactly we're doing. So that may change in the future. But for now, I would say you're safe to only report the people who are on the documents regarding the business, the tax return or the city license or anything like that. This is a decision maker that I pulled off of the FinCEN website. It kind of gives some specific guidance on who has substantial control. And so I think that if you're in one of those areas where you're not sure if somebody does or not, and you're going to fill out this paperwork yourself, you should go through and read that. I'm going to have the web address and everything later, but it's on this slide too. Okay, then we're getting the question, is my accountant or lawyer considered a beneficial owner? Because accountants and lawyers give you advice about your business. They influence you on what decisions you make. So do they have substantial influence? Generally, the answer is no. And this is coming from FinCEN. I've got their extensive little wordy blurb down there at the bottom on what exactly they said. But the basic answer is no, because you've hired that person to provide information. They're not actually a part of the business. Okay, I got a little wild with my clicker and clicked on mute. Okay, let's get back here. All right. So we have the forms. We know who the beneficial owners are. They're the people that are on our documents for the business. And then FinCEN has this title that it is the company applicant. So who is the company applicant? Well, for every domestic reporting company, which is the business, you're going to have a company applicant, and they are the person that is assigned to submit the forms. So for most of us, if we're submitting the forms ourselves, it will be us. If your accountant or your tax preparer is helping you submit them, then they are the company applicant. So here this question expounds on that. Is my accountant or lawyer my company applicant? If they're the ones submitting the forms, yes. Otherwise, no. And this is a good point here to go back to that. If your tax preparer or a lawyer that you know is offering to help you submit these forms, even if you have to pay them a little bit extra for their time, that's legitimate. FinCEN has said these people can help. But FinCEN also is starting to put out information very quickly that there's a lot of fraud going on with this. Like any government program, the people that are into fraud will be calling you saying that they can help you and that you must go with them and things like that. So just be very cautious as you select who's going to help you, that you get someone who is legitimate and not just trying to swipe all of your personal information, because FinCEN is asking for some very personal information as far as tax documents, facial recognition, etc. What specifically will you need to report? If you are planning on filling out these forms on your own, I strongly recommend going to the FinCEN site, which is there at the top, fincen.gov/BOI, and downloading the Small Business Entity Compliance Guide. They have put together a very good guide that you can download. It's, I don't know, 50 pages or something. And it goes through all of the steps with you. It has information on how to select your beneficial owner and not. There are Q&A areas on their website that go through all of the questions that they have gotten frequently and answered them in detail. So I very strongly recommend you check that out before you do anything. They also, in the Small Business Entity Compliance Guide, have some really nice checklists. So even if you're working with an accountant or a lawyer, you can get the checklist off of there and it will give you the information that you need regarding the business and the information that you need regarding each beneficial owner. And as you can see by the list there, it's legal name, date of birth, complete address, social security number or TIN number. If you're a beneficial owner, you even have to upload a photo ID of some sort. It's kind of similar for the beneficial owners as going through idme.gov, if any of you guys have done that. But as you can see, this is prime territory for people to scam you. So be careful. The beneficial owners have the option of giving their information to the company applicant, which probably they would have to sit down with the company applicant and do this together because it requires uploading their driver's license or passport photo or something. Or they can sit at home, go into the FinCEN program, request a FinCEN ID, and give their photo ID and everything that way. FinCEN issues them a ID number, which is unique to this program and this reporting, and it's probably not going to be used for anything else. Then they can give that ID number to the company applicant, who can then enter it into the company application, and FinCEN will match them up and have all that information that they need. If you have several beneficial owners in your company, this is probably an easier way to approach it. And that way it can work on people's own schedules and things like that. If they do get an ID number and anything changes, they move. That's about really the only information that would change, I think. But they have 30 days to go in and update their information with FinCEN. So that is another thing that you'll have to keep track of, because if you don't update it, then you're in violation and it gets complicated. Okay, when are the reports due? They are doing a very good job of easing us into this new reporting. For anybody that had a domestic reporting company that fits within the parameters of people that have to report, you have until January 1st of 2025. So we did have a whole year to do this reporting. And once you get to the actual form itself, it doesn't take too long to fill out. It's basically the gathering of all the beneficial ownership information that takes the time. For anybody that started a domestic reporting company on January the 1st, 2024 or after, they have 90 days in order to report to FinCEN. If you have a domestic reporting company that is going to start in January of 2025 or after, you're going to only have 30 days. So I think as this phases in, lawyers that deal with setting up LLCs and tax preparers that assist people with navigating that paperwork, but not giving any legal advice, we'll just kind of probably make that a part of the packet of documents that you have to fill out. So we do have plenty of time to figure this out and get it put into their system. Now, here's a little bit of a scary part. If you intentionally decide I have a domestic reporting company. I know that I meet the FinCEN requirements and I'm supposed to file, but I don't really want to give the government that information again in another department, or for whatever reason, you choose not to do it. Intentionally choose not to do it. You can have up to $500 a day with a $10,000 maximum and no more than 2 years imprisonment or both for doing this. Now, there has been some research and discussion with FinCEN. If you honestly think that your company, your business structure does not meet FinCEN's requirements and you don't file the paperwork, then you will not be given these penalties, or at least you will not end up paying them in the end. I imagine at some point they're going to start sending out letters, kind of like the IRS does. If you forget to file your tax return 1 year, it's highly likely that you're going to get a letter and they're going to estimate how much tax you owe based on previous years. So I imagine that FinCEN at some point, for the businesses that they think needed to file that didn't file, they're going to start sending out letters saying, okay, you now owe $500 a day in penalties. You will then be able to dispute it. And I'm sure that there will be a process to do that because it's still early days and we're figuring this out. But just know, if you intentionally choose to not do this, you could have some pretty hefty fines and possibly imprisonment. Oh, what am I just X out? Okay. Technical difficulties. I think I keep clicking in the wrong space on the screen. I have to rein in my clicker. Will my tax preparer assist me with this? I have been using tax preparers and lawyers throughout this part. There are some members of the tax preparer community who feel like this is not a tax issue. FinCEN is not over tax preparers. We are under the IRS. And so this is not our deal. The lawyers have to deal with this. However, there is a consensus that we do need to get this information out to our clients, even if we tell them we're not going to be able to help you, but you do need to do this reporting. So if you have a tax preparer, they may or may not be willing to assist you. I know some tax preparers, E&O insurance providers are refusing to cover this portion of things. So we're like the rest of it, we're all still figuring this out. But I think that if your tax preparer is not able to or not willing to assist you, they probably will have recommendations of trustworthy people who will, or other tax preparers or avenues to take. Okay, any questions? That's Jim. He's on a Zoom meeting on that picture as well today. So, okay, moving on then. All right, we're going to cover the Schedule F. And the basic use of the Schedule F is so we can calculate our self-employment tax, and then that flows into all the rest of our income, and we calculate our income tax. That's one of my U's and some of our lambs from previous years. Makes me ready for lambing season. This is the Schedule F that I mentioned earlier. As I said, it is used by all farmers except corporations, and they attach it to their other tax forms. Only the farming information goes on this form. If you have rental property or W-2 income or daycare, it does not go on this form. And the farming income never goes on a Schedule C because we have our own special form for farming. And it also is not used to report farm hobby income because hobby income is not considered a business. And so I have some information in the slides at the very end that are for reference only to help you determine, based on IRS guidelines, if the farm is a hobby or if it is a business. Because sometimes, particularly small farming operations, consider themselves a business, But whenever you start looking at the IRS parameters for reporting income and expenses, they actually fall into the hobby classification, and there are different rules for that. There are the tax forms that we attach the Schedule F to. This is a basic checklist for the Schedule F because, like I said before, your tax preparer will not want your box of receipts. They will not want to know all of your income and expenses. They'll only want to know the totals for these categories and if you got these tax forms or not. Okay, I have cropped up the Schedule F so we can actually see the lines on the PowerPoint here. So the top portion is our identification information, basically. It's pretty straightforward. Name of proprietor. If you are a sole proprietor, your name's going to go in there. If you have a partnership, probably the doing business ads, the fictitious name for the partnership will go in there. It could even be Frank and Ted's partnership. If you are a sole proprietor, you will use the Social Security box. Everything will go under your Social Security number. If you have a partnership or an S Corp, the entity will have its own tax identification number that the IRS has issued you. You have to request it, and it will go in there instead of your Social Security number. You have to tell them what your principal crop or activity is. This is because the IRS kind of keeps an eye on if you say that you're a market gardener, but you also say that you sold $500 worth of tires. Well, that doesn't really match. So they kind of keep track of if you're actually reporting what you're supposed to on the Schedule F. The intercode from Part 4, this is a business code that is used in the larger realm of business, but also kind of some IRS specific codes that they've chosen to use. They will either be in the tax software that you are using, and you'll be able to scroll down through them because it'll say like market gardening and have the 6-digit code, or mine is livestock production and has a 6-digit code. You'll be able to find those in the software. If you are not using software and choosing to mail in your tax return, which I do not recommend, but if you choose to do that, there are sources online and in IRS documentation for you to be able to look up that number. Your accounting method cannot change from year to year. You have to pick one and stick to it. If you change, you technically have to ask the IRS permission in order to do that. Most everybody here will be cash accounting. Whenever we have an expense, we record it. Whenever we get income, we record it. Accrual accounting is more complicated. It's based on if you buy something, when is the item used? Then that's when we'll record it. And for most small farm operations, the extra work isn't worth it. And so cash is more straightforward. It's more in line with what you see on your bank statement. The questions E, F, and G. Did you materially participate? This has to do with passive losses and income and other calculations on the larger tax returns, but most of us will answer yes to that, unless it is an investment farm for you, and then the answer would be no, because you just put in money and you aren't there every day or every week. Then did you make any payments that would require you to file a Form 1099? We'll touch on this a little bit more later, but a 1099 miscellaneous or a 1099 NEC, non-employee compensation, is required to be filed by you, the farmer, if you pay any individual or contractor $600 or more. This is part of the IRS's matching system to make sure that people are reporting their income accurately, checks and balances thing. So if you check yes, then the IRS is going to see if your Social Security number or employer ID number did in fact send those forms into the IRS, because whenever you file those, you send a copy to the person that did the work. You also send a copy to the IRS. If you answered no, then you're done. Yes.
Is that $600 in one
payment, or could you pay like full smaller payments to one person?
Good question. Is the $600 in one payment, or is it $600 over multiple payment? It's $600 per year. So if you paid somebody $10 a time, but it added up to $600, you have to file a 1099 for them for that year. If you paid them a total of $6,000, but it was in 10 payments over the year, or even 20, you still have to file the 1099 because it's over $600. But the 1099 will report the full $6,000 amount. Okay. Oh, and there is a penalty if you say that you filed the 1099s, but you didn't. I believe it is still $50 per 1099 for filing them not at all or filing them late. They are due by January the 31st to have them in transit to the person they're due to and filed with the IRS. I frequently get the question, do I need an EIN? As I kind of touched on earlier, if you don't have employees, you don't actually need one unless you're an S Corp or a partnership. Then you will need to request an EIN from the IRS so that that can be the tax identification number for the separate entity that is your business. You can choose to have an EIN like I have, because I don't want my 1099s or my 1099 miscellaneous or NECs or some of the tax forms that I file for people to have my Social Security number on them. The EIN, it should be protected. You should keep that number safe, but it's not as easy to take advantage of someone if you swipe their EIN than as it is if you swipe their Social Security number. There isn't a whole lot you can do with an EIN unless you're like a very, very good thief. Okay, this is part one of the Schedule F. So we have the name and everything at the top, and this is the next section down. It's the income section. For most of the people attending today, lines 1, 2, and 4 are the only ones that are going to apply, because the Schedule F form is for all kinds of farming operations. But for the people that are attending today, you're probably going to have one of those types of income, or maybe not all of them. Line 1 is this, you have to keep this separate. And this is a point that a lot of new farmers have to learn. But the sale of purchased livestock and other resale items goes on 1A. So if I'm selling my wethers, my castrated male sheep, as meat to people, and I have 10 customers, but I only have 8 wethers, and I go down the road and buy 2 from Lynn and sell them to my customers, I have to record that income separately for those 2 than I would for the 8 that I raised myself. Now on line 1B, I put in the amount, excuse me, the amount that I paid Lynn for those 2 wethers. So sometimes that's kind of an in-out situation. Sometimes you make money on those deals. Sometimes you lose money because you're just trying to make your customers happy. But that goes right there. That 1B is the only expense item that goes in this section of the Schedule F. It's kind of its own little anomaly. Then 2 is sales of livestock and produce, grains, and other production that you raised. So those would be the 8 wethers that I raised and sold to my customers. I would put that income on line 2. Most people at our scale don't get a 1099 for co-op distributions, and line 4A is agricultural program payments. This throws off a lot of new farmers because there are a lot of great programs through the USDA, NRCS, FSA, all of those USDA acronyms for high tunnels, CSP, Conservation Service, Conservation Stewardship Program, and all kinds of other acronyms that I can't keep track of, but they're really good programs. They have lots of benefits. There's cost share. There's guidance that they can provide. Good deals. The catch is, if you get a high tunnel through NRCS, and they pay you $5,000 in cost share in order to get it up, which I had several clients that kind of got surprised by this a few years ago whenever that first came out and was a big deal that everybody wanted to get into. If they pay you $5,000 cost share for your high tunnel to put it up, they're going to send you a 1099-G at the end of the year. And you're going to have to report that $5,000 as taxable income. All of the USDA programs that you participate in, it's taxable income. Jim and I are in the CSP program. We get cost share and annual payments for doing stewardship things on our land to make it better and improve it and these sorts of things. Planting cover crops, doing silver pasture, stuff like that. We get a 1099-G every year and we have to report that income. So that is just something to keep in mind whenever you are signing up for these programs and participating, that you will have to include it. Typically your expenses are more than the income, so it does work out, but it is reported. The rest of that I'm going to skip. However, I do have line item. Yes.
So it's 4A is where you would put what you received, and then is it the taxable amount? Is that where it would be? So you get your $5,000, you spend $10,000, let's say $8,000,
right?
To $8,000. So then you're the taxable amount.
I see what you're thinking, but that's not how the form works. Okay, so the question is, if we spend $10,000 on the project and we get $8,000 from NRCS as the cost share, do we then net it out and just put $2,000 on the 4B line, the taxable amount? That seems logical, but it's not how the form is set up. This is a very old form, so some of the agricultural programs that it was designed for initially have gone by the wayside. Today's agricultural programs, the entire amount is taxable. So whatever NRCS gives you, which was the $8,000 in this, you will put $8,000 in 4B or 4A. You will also put $8,000 in 4B. Now, there might be agricultural programs in the future where the full amount isn't taxable. Right now, that's not the case. We will put the amount that we spent on the high tunnel in the expense section down below. Okay. But like I said, I'm going to skip those last income, but I do have line items explaining each one of them in a little bit more detail as to what they are. A note on value-added products. Value-added, I feel like, has kind of plateaued, but it was really hot a few years ago. Value-added, by IRS definitions, is anything that you grow. If you do basic preparation for it to sell, you harvest your tomatoes and wash them and then sell them. You pick the green beans and put them in a bag and sell them. You grow the fryer on pasture and you do on-farm processing and sell the frozen bird. That is all just preparing it for sale. That's all farm income. That's all reported on the Schedule F. But if you do anything beyond that, that is considered processing, that is a value-added product. If you take your tomatoes and make salsa and sell the salsa, value-added. If you take the chicken and are able to roast it and sell ready-to-eat roasted chicken, value-added. The IRS does not want that on the Schedule F. That will go on Schedule C or on your main tax form, depending on your business structure. And the reason for this is some of the larger farming operations have gotten into value-added products, and the USDA programs and the amount of money they get for some of those programs is based on their total farm income. So if if you, if the majority of your farm income comes from value-added products, like you sell a few $100s worth of tomatoes, but the majority of your income is coming from the salsa side, and you report all of that as farm income, that is going to greatly inflate what appears to be your farm income, and you could erroneously get additional USDA program funding that you shouldn't, because that should be reserved for farmers. USDA and RCS is for farmers. So they require that you split that off and report it separately. I'm not going to go into the details of how, but just note that if you're doing value added. Same thing with agritourism. If you have your market garden and then decide to do a half-acre corn maze and charge people $5 a pop to go through your corn maze, agritourism. If people pay to take tours of your farm, agritourism. Anytime they pay to experience your farming life, agritourism. It also has to be reported separately for the same reasons. It goes on Schedule C or other tax forms. Okay, any questions? That's some of our lambs and my original guard animal, Alfred the llama, who is now moved on, but he lived a good life. I think he was 25 when he passed away. Okay. All right. This is the third section of the Schedule F. It is our expenses. The expense section is pretty self-explanatory. I'm going to touch on a few points that seem to cause people confusion, but like line 16 is feed. That's your total feed cost for feeding your animals. Line 30 is utilities. That is utilities used for the farm only. Seeds and plants, line 26, all the seeds and plants you bought to utilize in your farming operation. A few points that I do have those itemized on the next few slides. And let's see, I changed up my slide order earlier, so I want to make sure I'm going the right direction. Yes. Okay. Mileage. Online, sorry, everybody. Oops. Line 10, car and truck expenses. That includes your mileage. You have the choice with car expenses that you can deduct your actual expenses. If your vehicle is used for the farm and personal use, you'll need to prorate those. You can't take all of the vehicle expenses for the farm if you drive it to the grocery store too. Or you can take the standard mileage rate, which this is usually easier to track than all the expenses for your vehicle. It also, for those of us like myself who drive an older vehicle, is a better deal than the actual expenses for the vehicle. The standard mileage rate in 23 is 65.5 cents per mile. And in 24, it's going to go up to 67 cents per mile. And this is calculated based on the IRS formula to cover depreciation of the vehicle, what they anticipate typical repairs would be, taxes that you would have to pay on the vehicle. This is supposed to cover on a prorated per mile basis all the expenses associated with that vehicle. So a point of confusion that I've had lots of questions on, particularly this last year, is what specifically mileage can I deduct? If you run errands for the farm, if you go to TSC or you go to the feed store or you're going to buy seed, that counts. If you're going from the farm to the farmer's market or to your CSA drop-off delivery spot or something like that, those can count. But where it gets tricky is, and people sometimes forget, is if you live in a different location than your farm is at, you can't track the mileage from your house to your farm. The IRS considers that commuting miles, and they say everybody has to commute to work. So farmers shouldn't get to deduct that just because they're self-employed. So you can't deduct that. If you live on the same property as your farm, that's a moot point. You're in that case, you're driving from the farm to the other places, so you can count that mileage. Mileage logs, they do come up in audits occasionally, so it is important that you keep one. It is supposed to be written. You are asked on the tax return if your mileage is written and you have records. I very rarely actually see a written log from people, but I tell them that if we have an audit, they need to produce it. In the log, you have to have the beginning and ending odometer readings. You have to have the total miles for the trip, which it can be round trip if you go and buy seeds and then come back to the farm or your house in that case, because it's a farm errand, round trip, the date, and then you also have to have the purpose of the trip. The reason they ask this is so that people can't say, oh, well, I'm in an audit and I know that I ran errands that day, so I'm going to put down 25 miles and let's see, what was it I bought again? And then if they're getting really nitty gritty on your audit, they're going to go and look at your receipts and see what you bought that day and what your mileage log says. So it's unusual at this level to have an audit that is that detailed. However, they do have the option of doing that if they want to. This is more on depreciation. If you buy something that is $2,500 or more, you are not allowed to take and it is an asset in that case, you are not allowed to take the entire expense in the year it's purchased unless bonus depreciation is involved. And we're not going to get into that today because the rules change on an annual basis. But the $2,500 is spread out over several years, and you take a little bit of the expense every year. The IRS has useful lives that they have designated for different categories of assets, tractors, cattle, buildings, things like this, that you will take the $2,500, divide it by the number of years the IRS says, and then you will take that over the number of years in different increments, depending on which kind of depreciation you choose. But just know that if it's over $2,500, don't include it in your expense list. Keep it separate and tell your tax preparer about that. You have to have the date of purchase, if it was new or not, the purchase price, and if you're going to use it 100% for the farm operation or not. Because if you buy a lawnmower that you're going to mow the lawn at the house and also around the market garden, not a total farm use, probably split it 50-50. Farmers have their own property recovery periods or useful life for some things that they have that are specific farm assets. They are in your farmer tax guide. If you're doing your own tax return, I highly recommend getting one of these. You can request them from the IRS. They change them annually. It has this farm recovery periods in it. It also has an explanation of the depreciation table, has detailed instructions on how to fill out the Schedule F, common questions that they end up with. It's, I think, a 100-page document with an index. So I get a few of those every year. They'll only let me have 5, but otherwise I would be passing them out. Common depreciation question that I get is, do urban farmers claim depreciation expenses in the same way that other farmers do? Yes. All business owners claim depreciation on assets that they buy that are $2,500 or more. There are some specific things to farmers, but it doesn't matter where you farm. It just matters if you're a farmer or if you have a mechanic's garage or if you're a big corporation like Target. Okay, can I depreciate a barn remodel? This is a question that I get from people a lot of times whenever they're moving into value-added stuff. They've got a barn, they're gonna put a kitchen in it. Can they depreciate that? You can, as long as it is changing or restoring the building. If it's making a significant change. If you put a sink in the corner, no. If you build an entire new room with a sink and a wash station and some drying racks or canning area, that's a significant change. And so you can depreciate that. Otherwise, if you just put a sink in the corner, that's repairs and maintenance expense, and it can just go on the tax return with all your other expenses. Okay, any questions on depreciation? All right, business use of home. This is a deduction that I feel like a lot of farmers don't take advantage of, and they easily could. If you have a part of your house, even if it's just a desk in the corner, you can prorate your house expenses or use the $5 per square foot amount that the IRS has assigned. And that is your business use of your home for your farm business office. I take this for us. I have an office at home that is my tax practice office. So I do business use of home for my tax practice office. Jim also has an office, and his is used mainly for the farm. So we take that as business use of home for the farming operation. I highly recommend looking into this. You do have to have an exclusively used area. That can't be, you can't be using the kitchen table and say that that's your desk for the farm, even though it is for a lot of us, but it has to be a specific area. This flow chart is from the IRS. It's very handy to determine if you can use business use of your home on your current setup for your farm office or not. I love flow charts. Okay, I'm going to skip through that and just say that that is all for reference if you want to dive a little bit deeper into business use of your home. Labor is one of the expenses, and that section way back there a few slides ago of expenses on the Schedule F. Things to note on labor. There's a big difference between an employee and a contractor. And it doesn't matter how you feel the person should be designated. It's the IRS has specific parameters that if you meet this, you're an employee. If you meet this, you're a contractor. I see a lot of 1099 NECs, non-employee compensation forms, that are issued to people saying they are a contractor when in fact they are an employee. This gets very important whenever we talk about self-employment tax later. But if you direct or control the work that they perform and you control the financial aspects of the worker's job, you are an employer, they're an employee. You have to issue them a W-2. You have to pay half of the withholding tax. They have to pay the other half as withholding on their paycheck, like we're all used to with W-2 jobs. Contractors are like you hire Ron to come in and build the room to make the salsa in your barn. He shows up when he wants to. He buys all of the supplies. He hires extra people if he needs to or not. And when it's done, he gives you a bill. That's a contractor because he made all the decisions. He has all the financial control. You can issue him a 1099 NEC and be correct and accurate. So if you have employees or contractors, take a look at these slides for some more details on that in order to make sure that you're classifying them correctly and being fair to people on withholding taxes and things. Okay, this is the very bottom part of the Schedule F. This little section down here determines if we made a net profit or a net loss on the farm. We have the total expenses from Section 2. We have up here on Section 1, we had our total income up there, and they're going to meet down on line 34 for our net profit. If our income is more than our expenses, we have a net profit. If our expenses are more than our income, we have a net loss. Both figures are important. They just apply differently to the tax return. 36 is if you're an investor in the farm or if you actually are participating in the farm. Because if you're participating in the farm, all the money you put into the farm is at risk. If you have a net loss, you've lost that money. If you're an investment in the farm, it's not necessarily all is at risk. There are some investment rules there we won't go into. Okay, this is details on the profit and loss. That profit and loss figure is carried from the Schedule F form over to whatever form you are filing as your main tax form. 1040 for sole proprietor or qualifying joint ventured, you're a married couple. Form 65 for a partnership, you and a friend are farming together. 1120S, you've grown big enough with the company, you're an S corporation, you're an employee and a partner of the company. All of the Schedule F net profit and loss flows to one of these forms to be included with any other income that you have that is being reported. Okay, any questions on the Schedule F? Okay, we have a talkative bunch today. I know taxes do not cause other people to geek out the way they do me. That's our sheep flock grazing in the pluot orchard. We found if we don't leave them in too long, they don't nibble on the trees too bad. All right, withholding versus self-employment tax. Withholding, we're all familiar with that if we've had a job. Whenever we get our paycheck, it shows us what our gross pay was. It shows us what our employer kept out for Social Security, Medicaid, any state or federal tax withholding, city tax withholding, and then we get our net pay. Farmers are considered self-employed, so they pay all of that same withholding. They also pay the employer portion. So some people have griped to me that they pay more taxes than other people do, but I don't feel that this is accurate because whenever a business owner hires someone, they know they're going to have to pay their portion of the Social Security and Medicare tax. And whatever salary or wage they offer you is going to be based on that information. So they've already deducted that amount from the amount you get paid. You just don't see that part of it. Whereas self-employment tax, you really do see it because you see it come out in both ways on your tax forms. But withholding and self-employment tax are both Social Security and Medicare. Withholding as an umbrella term does include income tax as well, but we all pay the same taxes. There's a more detailed description of who pays what, employer or employee, and what you pay when you're self-employed. S-Corp officers are a little bit different because of the way the business structure is set up. You pay self-employment tax on the net income of the business. You also are considered an employee of the business and get a W-2 with withholding on that. Okay, any questions on self-employment tax? I kind of went over it fast because I want to make sure that we have time for the urban tax credit. Okay, so we had the Schedule F. It shows us what our net profit is. We use that to calculate what our self-employment tax is because we only pay self-employment tax on the business income amount. So Social Security and Medicare. An aside, I do know some farming operations that try really hard to make sure that their net profit is a 0 or even a negative number, so they don't have to pay Social Security and Medicare because they don't want to pay any more taxes than they have to. I always advise against this because it may mean you get more money now, but whenever you reach retirement age, you're going to have a minimal Social Security check if that is your only retirement source. If you're putting money away in your CDs or your savings account or under your mattress, whatever, for your retirement years, that's moot. But I think that the best policy to have is to report income and expenses accurately and pay the tax so that you have that later to draw from. Income tax, whenever we have the Schedule F net profit, it goes over to in our example for the moment, Form 1040 for our individual or married couple who are filing their taxes. It is added to all of your other income. If you had dividend income or a little bit of interest income, if you are an older farmer and are drawing Social Security, that income is included. If you have a job or your partner has a job, your legal spouse has a job, then all of that income gets reported on the federal income tax, the 1040, and they're all added together. That is some details on how all of that works. On the 1040, once you have your total income, there are adjustments that are applied. Like if you pay student loan interest, they adjust your taxable income based on that. Then your deductions are subtracted, which are most commonly known. One is the standard deduction that is set by the IRS based on your filing status. For married couples this year, it's $27,700. Individuals, unmarried people, it's half of that. Head of household is somewhere in between. That is deducted from your total income. This gives you your taxable income. Your self-employment tax is added to that. And then if you made any payments or anything like estimated tax payments, they are put in there. If you get any child tax credits, they are taken into account. And then at the end of the form, the 1040 form, you get your refund or your amount due based on what the outcome is. I'm not going into that in too much detail because it's a very specific individual situation as to what you'll have and if you get earned income credit and all kinds of details. That's a class in and of itself. Self-employed people can make estimated tax payments. If you owe quite a bit every year, you may want to consider making estimated tax payments. They are due 4 times a year. You can make them to the federal government, the IRS. You can make them to the state government that applies to you. Kansas City also has its own tax, and you can make estimated payments to them. We'll touch on Kansas City in just a little bit. But it is an easier way to kind of parse out the payments. And also the IRS wants you to pay in the income tax as you earn the money. So it can avoid some penalties at the end of the year. If you owe over $1,000 to the IRS, they start tacking on penalties because they technically consider that payment late. State of Missouri, and I believe Kansas as well, is $500. State calculations are similar to those on the federal return. They're kind of complicated and convoluted, but the state tax returns in this part of the country anyway, start with your adjusted gross income. So they don't start quite up far in the calculations as the federal do. They go partway down on the federal calculations, pull out that adjusted gross income number, and start from there with their calculations. Missouri and Kansas are very good about giving each other credit for taxes paid across state lines. So that is a good thing to know. I know a lot of people freak out whenever they have to do 2 state tax returns, but for Missouri and Kansas, it usually nets out about the same anyway. If you have a farm in one state and you sell products in another state, because I know a lot of Kansas City, Kansas growers sell at the city market down at the river market area. They may, and this is kind of situation specific, so this is a may, not a must. They may need to file a Kansas tax return and a Missouri tax return, just depending on their specific tax situation. Also of note is Kansas City, Missouri has a 1% earnings tax. If you sell at the city market or anywhere else in Kansas City proper, the net income from those sales is a 1% tax to Kansas City. These are some common tax documents that you'll want to keep an eye out for with your farming business. We've talked about most of them. The Kansas City RD 108 and the RD 109 is the reports that you file on that 1% tax I just covered. 1099-Ks are a fairly new form where they've come more into the highlight in the last few years. This is something that farmers need to prepare for, because any of your credit card or online processing providers, Venmo, PayPal, Cash App, Square, any of those, you may be starting to receive 1099-Ks from them. The congressional regulations on this came out, and practical application of congressional decisions isn't always feasible immediately. So the IRS is slowly phasing this in. But eventually, if anybody has over $600 in credit card transactions, they will be issued a 1099-K. Since it is phasing in, 2023 is 20,000, 2024 is 5,000. These numbers keep changing because they keep extending the phase-in period. But eventually, it will be $600, just like the 1099s are $600. They like to keep things consistent. The 1099-K is reported to the IRS. And so then they know how many credit card transactions you ran through at the farmer's market, how much money you made. Where it gets sticky for people is, like Venmo in particular, I'll use them as an example. Venmo charges you more money if you have a business account with Venmo than if you have a personal account with Venmo. So a lot of small farmers have a personal account with Venmo and run everything through there. It works great. But this new form is going to mess with that, because if you take farmers market sales through your Venmo account, and then you also, your sister reimburses you because you bought groceries for her, or you go out to eat and split the bill with people, or whatever your personal stuff is that you do on Venmo, the 1099-K has no way of differentiating between what was the farm sales and what was your personal reimbursement from friends and family, and it's going to all be on that report. And that's part of the reason they keep extending out the phase out, is they're trying to figure out how to sort this out. I'm recommending to people that if you can, get 2 Venmo accounts. Have one to run all your personal stuff through, one just for the farm stuff. If you start doing that now and get used to it, by the time they've phased in the $600, then you'll be set up really well to be prepared for that reporting. Okay. The Missouri Urban Farm Investment Tax Credit. This is receiving a lot of buzz. I think that it has good potential for small growers, but I think that it really needs some tax planning. Cannot stress that enough. It is for tax years beginning on or after January 2023. You can have eligible expenses to establish or improve an urban farm which focus solely on food production for sale or donation. The tax credit is 50% of whatever your improvements or establishment cost. You can have a maximum tax credit of up to $5,000. So you will have spent $10,000 in order to get that $5,000 credit. The total amount of tax credits for any farm is $25,000, which I found this statement confusing until I started delving in a little bit deeper, because you can donate money to an urban farm, file for the tax credit yourself, as long as you get proof from the urban farm that they used your donation to establish or improve something on the farm. So you can't have an urban farm and have 10 people giving you money for this project. You can only have up to $2,500 on that farm.
Would you still, if I'm the individual donating, I would still need to donate $10,000 to get that $5,000 tax credit?
Yes, if you're the person donating, you would have to donate the $10,000 in order to get the $5,000 maximum tax credit. Yes. The tax credit cannot be claimed in the tax year. Oh, okay, sorry, I'm misreading that. If you have a $5,000 tax credit, but your tax bill is lower than $5,000, you can carry forward any leftover tax credit for 3 consecutive years going forward. And we'll get into that a little bit more in a minute. So who's eligible? It's taxpayers who are incurring these expenses for construction or development for the urban farm. It's pretty vague on what the specifics are. We have worked with MASBA, who is overseeing this, on several projects ourselves. They have always been very helpful, very informative. So if you're kind of questioning if your project that you're thinking about qualifies, talk to them. I'm sure they'll be happy to answer your questions. The monetary donations that we mentioned a minute ago, you can give money to an urban farm. If you have construction or expansion activities that you're getting reimbursed by the state or federal funds for, you can't turn those in then for the tax credit. The IRS does not like double dipping. So if you put up a high tunnel and NRCS gives you cost share for that high tunnel, you cannot then turn around and say, the high tunnel cost me $10,000, so I should get a $5,000 tax credit, because NRCS already gave you $8,000 in cost share for that. Now, if they gave you $8,000 for cost share and you still paid $2,000 out of pocket, you would need to check with MASBA, but I'm pretty confident you could take the $2,000 and say, okay, I get $1,000 tax credit. There are some stipulations on what is classified as an urban farm. I think probably most people here today know if they're an urban farm or not, but if not, MASBA encourages you to call. They have I clicked on the link on their site that opens up this mapping program that is supposed to help you figure it out. And it looked like it was going to take me hours to figure out the mapping program. So I suggest just calling. How to apply? You can go to this website here on agriculture.mo.gov. There is an online application. There is a $100 application fee that you pay to MASBA, which I keep saying MASBA. That's the Missouri Agriculture and Small Business Development Authority. One of those long government acronyms. You also will be paying 3% of whatever your tax credit amount is. They're going to keep 3% for themselves as a issuance fee. And MASBA does, in fairness, use this money to fund other programs that they do. So it isn't just them keeping part of your money. Tax credits are going to be issued on an as-received application basis. So if you get your application in December, in November, or in October, it's possible you won't be funded because you got in too late and they had already spent the $200,000 that they had available for the calendar year. They also have said that if they don't spend the $200,000 in the calendar year, that's not going to carry over. If that money's not used, it just goes away and they probably use it for a different program. For anything that was expended in 2023, you have to have your application in by November 1st, 2024. So you have some time to get all your receipts together. Anything that you're going to build in this calendar year, 2024, you have until November 1st of 2025. An important thing to remember about this tax credit is it's not refundable. There are refundable tax credits and there are non-refundable tax credits. The refundable tax credits are a lot easier to apply and get your refund at the end of your tax return calculations. You get the money. Earned income credit is a very good example of this. You just get the money. This one's not refundable. So if your tax bill is much smaller than your tax credit, then you can carry forward that money for 3 years. But then if at the end of the 3 years, you still haven't used all of it, you just lose it. It just goes away. So that's why I really stress for people to do tax planning, to have a plan in place. Because I kind of did, Taxes are very individually specific. So these are very broad statements that I'm about to make. So don't be like, oh, well, Sarah said, because these are very broad. I kind of ran some rough calculations on my tax planner software. And in order to have a state tax bill, because we always think of taxes being high, but usually that's on the federal side. Usually people's state tax bill isn't too bad. Usually it's much smaller than the federal. So if your state tax bill, you have to have gross income in the range of $100,000. This is not gross farming income. This is after you've done the calculation on your 1040, your adjusted gross income that the IRS comes up with, that the tax amount is then figured on basically. It needs to be $100,000. So keep that in mind. I also ran a calculation on, okay, if you went ahead and spent the $10,000 and you got the $5,000 credit, you have this year, and then you have 3 more years, so 4 years to use the tax credit. So that's about $1,250 per year, $1,250. You still have to, at that point, have an adjusted gross income of $40,000. So I think that this could be a very good tool for people to make some improvements on their farm, cut their tax bill a little bit, but just take a look at your past tax returns, do some projections on what you think your future tax returns are going to be, because a lot of times in years of expansion, like you're putting up a high tunnel, you have more expenses, so the farm net profit is lower, so your adjusted income is lower, so your state tax bill is lower. But it can all be navigated and be a positive thing for your operation. It just is going to take some planning in order to ensure that it is. Okay. I recommend that you meet with your tax professional before you start any of this in order to make sure that this tax credit is for you. Do have a 4-year plan in place to kind of how you're going to use this tax credit, and contact MASPA. Like I said, they're very helpful. They're very available. Kind of even just call them. Jim, a lot of times before we start a project, he's great on the phone. He's a chatter. He'll call places and be like, okay, this is kind of in general what we're thinking for this project. Should we even bother applying or not? Is it like within the parameters? Those are good conversations to have because they will give recommendations and some guidance on if you should even pursue it or not, or if you have a good idea, but it needs to be tweaked a little bit, they can help you do that from the beginning. Questions on the urban tax credit? Okay. All right, I wasn't sure if we'd have time for sales tax today, but since everyone has been so quiet, we do have time, so good job, team. I started with a sales tax exempt question because I wanted to touch on it, even if we couldn't get into sales tax. A lot of people have confusion between sales tax exempt, farm exempt, or sales tax exempt in general. The question I got a few years ago was, what kind of items can I buy with my sales tax exempt number? Sometimes I go to Tractor Supply and I'm tax exempt. They don't ask for any number at all because Tractor Supply, Orscheln's, probably Feldman's and Liberty, at the register, they say farm tax exempt and you say yes or no. And then they push buttons on the items that are farm tax exempt. But if the person goes to Walmart and buys ingredients for value-added products, or even if you go and you buy Ziplocs to put your green beans in to sell at the farmer's market, they want your sales tax exempt number and you have to fill out all kinds of paperwork. And sometimes they are not familiar with it at the register and it turns into a big mess. So Missouri and Kansas and probably other states have a farm tax exempt list. It is items that have been designated by the state taxing authority, the Department of Revenue, as if you're buying these items and you have a farm, you don't have to pay taxes. That's why at the farm stores, TSC, Orscheln's, Feldman's, They just ask it as a routine question because most of the people that shop there have farm. There are also other types of sales tax exempt. We have a distillery where we take our tree fruit from the orchard, we distill it, we sell distilled products. We're sales tax exempt because we are a manufacturer. But in order to get sales tax exempt status with anybody, we have to fill out the Missouri or Kansas, we do business in Missouri, sales tax exempt form, submit it to the person that we're buying manufacturing supplies from. It can only be sales tax exempt on manufacturing supplies, our bottles, our bar tops, our labels. Those are all things that go into manufacturing our product. So they are sales tax exempt. If they don't have that form on file from us, they are supposed to charge us sales tax, even if we're buying bottles or labels from them. Value added, as we discussed, is not farming. So you can't go to the farm store and tell them you're farm tax exempt on canning jars that you've bought at TSC to put your salsa in. You have to fill out a sales tax exempt form to give to them so that you can be under the manufacturer sales tax exempt umbrella. There are other kinds of sales tax exempt, but those are probably the two main ones that will affect anybody here. But that is the main point of confusion for people, is farm tax exempt versus the other types of tax exempt status. And then you get into nonprofit, and that's a whole nother thing. Okay. Let's see. We can talk about sales tax, or we can go into more depth of some other topic. Does anybody want to weigh in on anything? Okay, then I'm going to talk about sales tax. All right, sales tax, I put it at the end because this isn't actually something that a tax preparer will probably help you with. I have a few clients that I help them with their sales tax. It's more because I like helping them because they're my clients more than it's a tax topic. Sales tax is collected by the state. Technically, that part of your sales is never your money, according to how the state views it. It is money that you are collecting for them and holding and turning over for them. It is not part of your income. So whenever you calculate sales tax, it is on your total retail sales, unless if you're backing out, which most market gardeners do use the back out method. You charge $5 to the person at the farmer's market because that's an easy number and we're dealing in cash usually, easy exchange. Then you take your total retail sales, you do your sales tax calculation, subtract it, and send that in. Now, like if we get a Walmart or Target or somebody, they use the add-on method, which your item costs $5. They then add sales tax on top of that and charge you $5.92 or whatever. That's kind of low, but anyway. So most of our discussion is going to be about backing out because we don't want to deal with change at the farmer's market. You do have to register for a sales tax number with the state you are selling in order to collect sales tax for them and report it and send it in to them. Each area has their own sales tax rate. Kansas City and Missouri both have very good sales tax lookup options by zip code that will tell you the specific sales tax rate for that spot. And your frequency of reporting your sales tax and paying it in is based on your amount of revenue. The more revenue you make, the more frequently they want you to pay it in. Most small market gardeners pay on an annual basis. In December, at the end of December, you calculate your total retail sales. The report's due by the end of January, I think. Now, yes, getting all my dates mixed up. Covered all of that.
And so you're wanting to track, like if someone's selling in Kansas and in Missouri, they're going to track exactly where they're selling it, the rates for those, and pay them to the respective different states.
Yes, you track your sales by location, because you're in each state and each town and each location and each town, because you're going to pay a different rate on each of those potentially. A note for farmers in Missouri: if you're selling at a farmer's market or a common marketplace and there are products that you grew, you can sell up to $25,000 and not have to pay any sales tax. They have a really nice exemption. Kansas does not have this. And for that exemption, products must be grown by the farmer. They must be grown and then processed by the farmer. So if you're making jam or fermented vegetables, you don't have to pay sales tax on those. No items that are purchased or resold can be included in the $25,000 exemption. Okay, here's our example of the different sales tax rates for a location. Whenever you, this is Missouri in our example, whenever you file your annual sales tax report with Missouri, they already have it divided out and have the sales tax rates for each location plugged in. So we sell at the Kansas City market. So whenever I go in and first load my first sales tax report that I ever sent to them, I told them the address of the Kansas City Farmers Market, looked up the sales tax location for that area, and it's now on my form in my account that I file online with Missouri Department of Revenue. So I don't have to look it up every time. I do have to check periodically to make sure that it is current, because these do change. And it's not always on a consistent basis because it depends on the city and county voting timing. But when we sell at the city market, even though our farm is located in Richmond, I have to track that information separately, all of those sales separately. And we pay Missouri food items tax if we're over the 25,000. We pay to Jackson County, we pay to Kansas City, Missouri, the city. There's also some special taxing districts in the city market area, which you can have special taxing districts anywhere. So it's in the zoo district and the streetcar district. So whenever I pay our sales tax, I pay at a rate of 6.85% in this example, but I don't have to divide it out to all those different ones. I just pay the total amount to the state of Missouri, and then they parse out the payments to each taxing district. So it's good to know this information, but it's not that complicated on your report. This is the example I mentioned earlier about the difference between backing out or adding on. At farmers market, I know adding on doesn't work. Nobody wants to deal with change. It's not feasible. But if you have your own farm stand at your house or something, it might be something to consider because you do make a little bit more money. If you have the $8 sales price, then you're going to have 55 cents sales tax. If you back that out, you're only going to be able to keep the $7.45. But if you add it on, you're going to be able to keep the $8. So it is a way to make a little bit more money, particularly if you have high sales volume, it can add up. Missouri a year or two ago divided off certain categories that if you're over the $25,000 exemption, you have a couple different sales tax rates. Basically, anything on the SNAP benefits list falls into the right category of the 1.225. It's a lower sales tax for people that have SNAP benefits or items that fall into the categories of SNAP benefits. Everything else stays at the same state sales tax amount. This is important because if you sell live animals and fruit and vegetables, You have to track those separately in order to report it on your sales tax report. So you're charging the right amount.
So,
Yes.
So Mickey wants to know, so would the city tax with casino still need to be paid if it was under the $25,000 exemption, or is it just the state's tax percentage you are exempt from?
Okay, the question is on the example a few slides back, does the Kansas City sales tax still have to be paid even if you're under the $25,000 exemption? The $25,000 exemption covers all taxing districts in the state of Missouri. So if you're under 25,000, you don't pay any sales tax to anybody, as long as you meet the requirements of that exemption. The 1% Kansas City earnings tax that I mentioned way back whenever we were talking about state and city income tax, that is due, that's a separate tax. It's a Kansas City income tax, whereas right now we're talking about Kansas City sales tax. The 1% is due on the net profits that you made in Kansas City proper, or if you lived in Kansas City proper, it's any sales that you've had, even if you sold in Lee Summit.
More exemption question.
Uh-huh.
So if someone lives in Missouri is selling in Kansas, let's say you sell $48,000, 24 are in Kansas, 24 are in Missouri. Your whole, you're still exempt from that 24,000 selling.
Yes. Yes. The question is, if you sell in Missouri and Kansas and you sell $25,000 in Kansas and you sell $25,000 in Missouri for a total of $50,000, you're still exempt from the $25,000 in Missouri because it did not go over $25,000 for those state sales, even though your total farm sales did go over the $25,000. Yes.
So when you actually file the 25,000 exam, it's going to be on the state filing, or how do you?
If you fall within the $25,000 exempt status, you don't have to file anything. The reason they passed that was to help make it easier for small market gardeners and smaller operations. So if you make less than 25,000, the state's not going to look at you at all for sales tax.
But it's not like if you sell 50,000, you're not exempt from the first 25,000.
Correct. If you sell 50,000, you're not exempt from the first 25. You have to pay sales tax on all the 50,000.
So you found that they sent you, if you get to file, that's not part of the 25 exam. That's something like, for example, my first market last year. So when at the end of the year, they send me like the tax from Missouri State. So I have to file. So when I file, like you said earlier, that they give an estimate, so they be a certain fact.
Right.
So I paid nearly, like 1,000. They and then I knew that 25,000, but they send me a tax, and when I file it, I end up paying $dollars.
Right. Okay. The question is, she got some paperwork from her farmer's market that she had to fill out for Missouri sales tax. And Missouri sent her a letter saying she owed, was probably $500 or $600. Those are numbers they like, in sales tax. But whenever she logged onto her account and reported the sales tax, it was only like $100 that she owed. This is an example that we discussed earlier. They will, Missouri, whenever they're sending out these types of letters, they kind of have a minimum. Kansas City does this too. They have a minimum amount that they send out. So it's usually $500 or $600 they say you owe, regardless of what you've reported in the past or what their estimate shows you should owe. They like that number. So that's why the tax letter said you owed more than you actually did. If you took a year off from farming and they sent you that letter, you would need to go in and file a 0 return in order to take care of that. And if you have made over $25,000 in the past, or if you didn't know about the $25,000 exemption, and they send you this letter, or you don't file a 0 return, you probably will need to contact the Missouri Department of Revenue, or go on and you can file the sales tax form stating that you are exempt. So you'll need to do that. But if you have never filed sales tax and you're starting out new, and you don't file sales tax, then you won't have to file that form. The reason you would have to go in and check that you are sales tax exempt under the $25,000 limit is because the revenue departments assume that if you did it one year, you're going to do it the next year and the next, and you have to let them know that things have changed.
Sarah, there's a question on the difference between different markets, I guess. So like, if you do wholesale for 25K and direct to the consumer for 24K, all in Missouri, exempt, or do you have to do all 49,000?
The question is, if you sell $25,000 of wholesale in Missouri, and then you sell $24,000 of retail in Missouri, if you fall under the $25,000 exempt umbrella, I would say yes, because the exempt requirement is sales that you have made through a farmer's market. So your wholesale items typically don't go through the farmer's market and are exempt from sales tax. And so I would think that you could do that, yes. Okay. All right, we made it through sales tax. So if you completely zoned out because you don't geek out on taxes like I do and don't remember anything else from today, please remember this stuff. It's good to establish a good relationship with a tax preparer. They need to be somebody you're comfortable with, because you're going to be discussing the nitty-gritty of your income and expenses and things like that. So you need to be comfortable with them, regardless of their education or certification status. You need to feel like they're competent and that they're going to help you if you end up in a situation where you're having problems. Keep up-to-date records and accurate records, even if this means spending a little bit of money to hire somebody to help you with that. A good way to do, if you're going to do it yourself, is has a designated day every week that you sit down, and even if you're only recording one receipt that week, you are keeping on top of it and keeping it current, because sometimes we get these receipts and it says $5.25 and it says sale at the top and there's no other information, and 2 months down the road we can't remember what that was for, but that week we probably will remember what it is. And if you do not have a tax preparer and you prepare your own taxes, if you are going to make a big decision like selling property is usually a point where people get caught on tax things, sit down with the tax preparer. Even if you only pay them for an hour of time, sit down with them, discuss that decision with them before you make it, because their education and experience can help you save a lot of money, even if you're preparing your own tax returns. I think maybe we had a question.
Yes. She's in Kansas, and she's still there.
Okay, the question is, if this person is in Kansas, can they still hire me? Yes, I can do tax returns for any state in the US. I choose not to do foreign tax returns because that gets more complicated than I'm willing to handle. I can do taxes for any kind of business except C corporations. I choose not to do those. I do a few nonprofit tax returns. So yes. let's see. Yes.
Big farm stuff.
Mhm.
Uh-huh.
Okay. The question is that last year she went to a tax preparer and they put all their farm stuff on a Schedule C, which is Schedule C is for people who own businesses other than farming, like a mechanic shop or a retail clothing shop or something like that. We're going to Schedule C if they're a sole proprietor. So the accurate, correct thing to do would be to amend the tax return and report your farm income on the Schedule F on the amended return. And you would include a statement with the tax return saying, wrong form was filed, sorry, here's the right form. The tax outcome, as far as if you owed or if you got money back, is probably going to be about the same because the Schedule C calculations are very similar to the Schedule F calculations. But in order to have things accurate and correct with the IRS, it would be good to amend that because if this year you file a Schedule F and don't file a Schedule C, you could potentially trigger some automatic letters that the IRS computer sends out and humans really don't see before they go in the mail saying, hey, you forgot to report your Schedule C income, so we think your tax return is wrong this year. So. Okay, any more questions? Nope. Okay, there's my info if you all want it or need it. I do give a 30-minute free consultation to people who are interested to see if I'm a good fit for their business. I do not use this time to teach you how to do your own tax return. Have to go somewhere else for that. But if you don't use me and you aren't comfortable doing it yourself, please do get somebody that you're comfortable with. So thank you everybody for coming. Yeah. Mm-hmm. Yeah.
We have information on urban farms that in the BOI.
Both farms, fishing and taking the out list, or is it on the sorry?
The list of items that are farm tax exempt, it would be in the farmer tax guide that you can go on the IRS website or just Google get farmer tax guide from IRS and it will come up and they'll mail it to you. This information is also on the IRS website. I'm going to stop sharing. Does that work for you?
Okay. And then, can you just tell people online that I will? Oh, do you mind if we send out?
Yeah, that's fine. I designed it for people to look at later because it's a lot of details. Okay, I'm going to leave then. Okay. Do we want to leave on your laptop too?
Yes. So, but then just